Hi, welcome to Sean's Mortgage Agility. My name is Sean Smith, and I'm a mortgage loan officer at Morty. Originate loans in Texas, Oklahoma, and Florida. If you have any lending needs in those states, please contact me. Today, first of all, I'd like to say I am not your mortgage loan officer yet. I am just a mortgage loan officer. These videos are only for educational purposes, not intended for establishing a MLO client relationship of any kind or service as a substitute for a consultation for your mortgage loan officer and an attorney. Specific financial and legal issues, concerns, conditions always require the advice of appropriate financial and legal professionals. With that said, let's move on to our topic today, which is annual percentage rate and lender credit. Amount financed. The lender deserves the credit for giving you a credit. A little MLO humor, very little. Amount financed. It's the amount you are borrowing from the lender minus most of the upfront fees you pay at closing. If you receive a closing disclosure, the amount of financed is shown on page 5 under the loan consultations. If you are getting a loan for a reserve mortgage, HELOC, manufactured home, or secure that is not secured by real estate, or loan through a certain type of home buyer assistance program, you probably won't get a closing disclosure. For those types of loans, you will get a truth in lending disclosure, probably. On the top of the document, you will find a total of payments. For example, if you have $300,000 loan, but the lender is charging you $3,000 as a cash to close, the amount financed would be $297,000. The actual cost of your credit, measuring annual percentage rate or loan fees and monthly payments determines the actual cost of credit. Compare different loans using APR. That's what you want to do always, is use your APR to compare loans because it takes into account your interest and your fees. So there's two types of APR. We have fixed APR. The interest rate applies to the principal amount borrowed, and it does not change. The APR calculated is based on a fixed interest rate. The amount paid by the borrower stays the same. The variable APR, the amount paid, changes because the interest rate varies from time to time, as in ARM, and a variable rate mortgage otherwise. For instance, credit card holders who pay their bills in full and on time are not affected by APR. The actual cost of your credit. Okay, when we calculate APR, we do that by subtracting the prepaid finance charges from the loan amount, the amount financed. Interest paid, including the PMI, is applied against the amount financed. You divide that by the loan amount, the principal, divided by the total number of days in the loan term, multiplied by 365 days, which would be 1 year, and then multiplied by 100 to convert that into a percentage. And that's what this formula is all about, the APR formula. Okay, lender credits. That affects your fees, of course. So it's going to reduce your closing costs but increase your interest rate. Lender credit works the same as points in reverse. You pay a higher interest rate and the lender gives you money to offset the closing cost. When you receive the lender credits, you pay less upfront, but you pay more over time because the interest rate is higher. Okay, let's go to an example of that using our spreadsheet that I've created. Okay, here's the example in the spreadsheet I've created, enter APR. And what we're looking at is the closing costs. We're saying that our closing costs are coming to $24,000. Our payment for the loan is $1,994.92. That brings our APR to 7%, as opposed to our interest rate, which is at 6.7. So it is higher because it includes the fees. So we're subtracting the cash to close, as we talked about in the slides, which brings our loan amount, which started at $300,000. That's our loan amount. And it brings down to our loan amount after taking out the cash to close. It comes to $297,000. Here is the formula that I used in Excel to show that, how that's calculated. So that, of course, would be your loan amount. And then that is your term, which is 360 months. And your F3, which would be your payment. That is your payment for the loan, including interest and principal. And then we times that by 12 to bring it up to an annual amount. And that's how we get our 7%. The lender credit would affect that by decreasing your closing costs and increasing your interest rate, of course. All right, so that does it for our topic of APR and lender credits. Have a great day.